This week, history is being made. The Fed is gearing up to cut rates for the third time in 2025, and the S&P 500 is still sitting just beneath its all-time highs. That's 3 rate cuts in a year without a major recession, without a financial crisis or a pandemic or anything dragging down the economy. They are cutting rates into good times, something we almost never see. And every time the Fed has cut rates, while stocks were near highs, they went up the following year. The S&P 500 has risen by an average of 13.9% over the next 12 months. And at the same time, we're experiencing one of the biggest technological revolutions of our lifetime. Artificial intelligence is boosting productivity in ways we have not seen since the Industrial Revolution or the birth of the internet itself. But AI has a downside, too. It's killing jobs. November payroll data revealed that we actually lost jobs last month. And job creation has been declining all year. The unemployment rate just hit 4.4%. So what happens when stubborn inflation, a cooling labor market, and the biggest technological boom in 2 decades all collide with a Federal Reserve that keeps cutting rates? Well, let's break it down. Now, on Wednesday, the Federal Reserve will execute its 3rd rate cut of 2025. And the reason hasn't changed. The labor market is cracking. For 4 straight years, the focus has been almost entirely on inflation, but that's only half of the Fed's job. They're also tasked with maintaining stable employment. Earlier this year, we learned that last year's jobs numbers were inflated. The government revised the report and admitted that they overstated job creation by 911,000. Nearly 1 million jobs vanished on paper overnight. That's what started the cuts, and the data just keeps getting worse. So the Fed has to cut. They have no choice. The economy needs lower rates to stimulate spending, borrowing, and investing, to let businesses breathe easier and consumers to loosen their purse strings. But inflation is still running hot. Core CPI is sitting at 3.1%. Prices are up almost everywhere, a full 110 basis points above the Fed's long-term 2% target. So inflation says don't cut, but the labor market says you have to. And all of this is happening in one of the most overvalued stock markets in U.S. history. According to Bloomberg, valuations are near higher than the peak in 1929, higher than 1965, even higher than 1999, the peak of the dot-com bubble. You see, normally rate cuts happen in recessions, in market crashes, periods of financial stress like 2008, 2020 after COVID, but not this time. Despite the weakening labor market, GDP growth remains strong, over 3% annually. That alone is creating a fierce internal debate inside the Fed. Do they cut another 25 basis points, or do they go bigger, cut 50? Because look at the data. Consumer confidence in jobs has plunged to just 34%. That's a multi-year low. The jobs are plentiful index has collapsed 22 points in 2 years. The labor market has materially weakened. But meanwhile, inflation is still elevated. GDP growth is above trend, and AI is supercharging productivity and corporate profits. No wonder the market refuses to fail. The S&P 500 remains just a hair beneath all-time highs, still up more than 35% from the April lows, making it one of the strongest 5-month rallies in modern history, right alongside the early stages of the 2009 recovery. And now another rate cut is about to pour gasoline on the fire. Yes, valuations are stretched, but it is nearly impossible to build a credible bear case when the backdrop looks like this. You have above average inflation. Yes, it drives up housing prices and food prices, but also stock prices, bullish. 3% GDP growth, bullish. A once-in-a-generation AI revolution, hyper-bullish. 3 rate cuts with more on the way. Trump appointing a new Fed chairman, heads up, he's going to be super dovish, he's going to want to cut aggressively, bullish for stocks. We have $700 billion in annual capex in the tech sector. That stands for capital expenditures. The big guys, your NVIDIAs, your Meta, your AMDs, $700 billion a year they are spending on infrastructure, on data centers, all that money pumping into the economy. The Fed just ended its quantitative tightening program. We have $2 trillion in annual deficit spending. Do I like it? No, but it's inflationary, it's being pumped into the market, and it's going to cause asset prices to rise. We also have 13% year-over-year earnings growth on the S&P 500. nearly 50% above the long-term average of about 9. How do stocks go down in that environment? Could we see short-term volatility? Of course, Trump's in office. The market hangs on every Twitter post. But long-term, asset holders are being rewarded and will continue to be. Gold knows it. Silver knows it. The housing market definitely knows it. Markets are pricing in what's coming. Lower rates in a hot economic backdrop equals higher asset prices. And this is one of, if not the best long-term environments for owning gold, real estate, stocks, and other assets that we've ever seen. The third Fed cut of 2025 is here. Strap in. This bull run isn't done. Not even close. And if you haven't already, hit the subscribe button down there in the corner so you don't miss the next major update. This is going to be an historic finish to what's already been a stellar year.